everybody. Today we're going to be looking at an in-depth market maker model guide for the AM session specifically. All of these chapters should have a time step next to it, so if you want to skip ahead, feel free to. But it's going to be a longer video. We're going to try and cover basically everything from a higher time frame down to lower time frame, what to look for when you're framing a trade setup, and we'll have some examples for each of them. I'm going to have PDFs and external videos that you can use for references. I'll also put those in the description below for each of the chapters, as well as some ICT videos that should assist with the concepts. So we'll get straight into it. First thing we're going to look at is time. So for the New York kill zone, New York open kill zone specifically for futures, we're going to be looking between 8:30 and 11 o'clock Eastern Standard Time. Occasionally we can shift the kill zone to 9:30 to 11, which most of our focus will be around those two time points. Now, understand that within a morning session, there's always going to be one market maker model that could either start at 8:30 or start at 9:30, but most times you want to see it completed by around 11 o'clock. And these times are very specific elements. They don't change during the day. The only times they may shift is according to news profiles, and we'll cover that later in the video. Every single day, this is going to be the kill zone between 8:30 and 11, and you're going to be most times focusing majority of your tape reading around 9:30 to 11. Now you can frame every single morning session based on the standard power of 3, either open, high, low close for a bearish candle or open, low, high close for a bullish candle. So as long as you know that there's going to be an open, which will be the time either at 8:30 or at 9:30, and then a manipulation or a Judas below that price, expansion up towards a target, and then a closure most times below that high that was placed in, you're only going to have two frameworks, and it's going to be a bullish framework based on your higher time frame or a bearish framework, all based on your higher time frame. Now within these power of 3 candles on a higher time frame, you're going to have your entire market maker model within that range. Now you can use this power of 3 and kind of frame it just on the New York session. So if we're bullish for the New York session, we know it's going to be a market maker buy model. If we're bearish for the New York session, you're going to see a market maker sell model. And all that's going to be contained with the opening price at 8:30, a low dropped in between the opening and close, a high put in before the closing price, and then the closing price of that bullish candle at 11 o'clock. Now, you could see the entire market maker model form within the kill zone of the New York session, or you could see half of it. In this example, we have the London session creating the sell side of the curve, and then the New York session creating the buy side of the curve, all while it's reacting to specific time and price levels. Now we'll get into time profiles and market maker model profiles later on into the video, but as long as you can understand this general framework that every single morning session we will have a market maker model, either a buy model or sell model, you can find and utilize different entry opportunities and techniques to get in line with price before it hits its draw on liquidity. Now, when we're looking at the New York session specifically, most times it's going to be an intraday chart. So either the 5-minute down to the 1-minute chart. Now to look for your sub 5-minute market maker models, you need to understand higher time frame bias. I have a whole video on 1 hour and 15-minute bias. I'll link that in the description below. But you have to have some sort of a higher time frame draw on liquidity. And most times it's going to be going from ERL to IRL or IRL to ERL. So your ERL is going to be a pool of sell side or buy side liquidity. Most times it's going to be time based. So previous day low, previous session low, things like that. And your IRL are going to be fair value gaps on higher time frames. Specifically, I like to use the 1 hour and the 15-minute chart in premium or discount. So if we have a fair value gap in premium, we're going to be looking for a sell side liquidity pool in the form of ERL. If we're going to say discount, we're going to be coming from a ERL of buy side liquidity pool. Now, I have an entire video just dedicated to this concept and what to look for in the New York session. But this is the general framework. So we're going to be going from higher time frame to higher time frame. And on the lower time frame, we're going to get our tradable market maker model, obviously starting within the kill zone. So we can either come from a fair value gap, because the two functions of price is either to fill in inefficiency or run on liquidity. So we're either going to fill in inefficiency on the higher time frame and create a market maker buy model off of it, or a sell model, whatever it may be, and trade to an ERL. Or you'll see it the other way, where we actually have a sell side liquidity pool traded into. You see a lower time frame market maker buy model, and we go up into a premium IRL on the 15-minute or the hourly chart. These are both flippable for sell models as well, but it's all going to be based on a higher time frame level being hit, and on a lower time frame, we then have a market maker model. So your time frame pairing is going to be important in this case. So 15-minute on a higher time frame normally will produce a 1-minute market maker model. An hourly higher time frame, either for value gap or liquidity pool, will create a 5-minute market maker model. And those are the two you're mostly going to use when you're trading intra-session, specifically for New York, and those are the ones that I will use within my trades as well. And it's not more complicated than this. It's going to be reacting off a higher time frame level, and you're getting a lower time frame entry using a market maker model. There's no secret gem. There's no missing piece. This is really what price does. And as long as you can see it for the most basic aspect, the more difficult aspects you can use with entry techniques and reading price maybe intraday, all are more clarified and easier to do when you understand this most basic general framework of price and its functions to go from external range to internal range and internal range to external range. And this happens every session. So whether you want to use it in the New York session or the lunch session, this framework, as long as you use a specific entry technique or a model, will happen every day and every session, and it won't stop. Now, as we break down this higher time frame view into a lower time frame, this is what we're going to get: our standard market maker buy model, and the different stages of the market maker buy model. So we'll have smart money reversal down at the bottom, a low risk entry. In this case, it'll be a low risk buy. First stage accumulation, second stage of accumulation, and then obviously the terminus above whatever our drawn liquidity is. In this case, we have original consolidation. And most times it's going to be the higher time frame level above it in the form of an ERL. Now, there's plenty of YouTube videos and content you can use to study the different stages of price delivery, especially if you want to do things like swing grading. There's a bunch of free content on YouTube that you can do a quick Google search and find. So I won't cover it too much, but understand that a kill zone will start at different times in this market maker model. We could start it somewhere over here. This will be your 830 price point, and you're going to be looking either to trade into the IRL, or you're going to look to trade after the smart money reversal happens and it trades up into here. But every day we may start at a different spot in the market maker model. We could start all the way up here at 830, or down here at 830, or over here at 830. And as long as you can identify where we are in the stage of the market maker model, you can find what do we expect to see price next and how do we find an entry off of that. So these are your profiles as well. I have a PDF I'll link in the description below, or it'll be in my Discord. The Discord link for sure will be down there. And there's about 7 or so profiles that you can look for that start at 8:30 or start at 9:30. And your economic calendar will help with that as well. So normally what you'd like to see is, best case scenario, you have something like this. Starting at 9:30 is something like this. So we have our standard 9:30 open. You have your open, low, then the high put in at time, so around 10:30 or 11, and the close obviously below the ERL. So normally you want to have a Judas swing at 9:30, and then some sort of an entry type, either with a breaker or a for value gap and discount, and we'll cover that further as well. And then obviously there's going to be multiple opportunities to get into price before it reaches its draw. Other times you're going to have something like this, where there's a very shallow 9:30 Judas swing, and then it starts trading back up. Other times, this will be your 8:30, and 9:30 may start over here. You're going to have a second stage of accumulation. Now, when you're reading the market maker model on the lower time frame, besides anticipating these 3 kind of entry types, and your last one is actually your silver bullet, it's your second stage of accumulation, or your second stage of distribution in a market maker sell model. So this is going to be normally the least amount of resistance, quick entry to target. But while you're reading this on the lower time frame, if you see the breaker confirm or a market structure shift, and you can now look for an entry long, between the low risk entry and the first stage of accumulation, most times what you'll see is an internal range stop sweep. So if we drag this over here, what you can see is if price comes down, tags into the higher time frame level, trades off of it, sometimes what you'll see is an entry, and it may chop around, sweep the entry once, and then continue to climb. Now, if you can predict something like this or anticipate it, this sweep below the short-term entry won't scare you and it won't run into your stop. You may be comfortable with it so you won't move your stop too tight. Now, if it doesn't happen in the low risk entry point, sometimes what you can see is it continues up and then you have that same kind of consolidation and internal range stop sweep happening on the first stage of accumulation, and then it runs to target. So between the low risk entry and the first stage of accumulation, or the low risk sell and the first stage of distribution in a sell model, you'll have most times an internal range stop sweep. You can also pair that up with the silver bullet time, because most times silver bullet will be this leg in price. It's already expanding towards the draw, and you can anticipate a stop run. You can either get in right after the stop run, or if you're holding an entry, as long as your stop is not trailed too tight, you'll see something like this and either get in if there's another PD array you can enter on, or just not be as worried as an internal range stop run and not look at this as a selling opportunity. So swing grading and all those advanced concepts, you can find a bunch of content on that, but understand that there is multiple opportunities to get in. This is obviously going to be your best one, and always anticipate some sort of an internal range stop run while it's trading to the target. Also, it's good to note that your smart money reversal 9 times out of 10 will have SMT that confirms the smart money reversal. So always look between ES and NASDAQ is what I favor, sometimes between YM as well, but you'll have SMT within that higher time frame level or for the stop sweep that happens right at the start of the kill zone. Now, here are some of the profiles that I look for on a time scale. So this one, we have 8:30 starting the first Judah swing. So you can assume that all of the sell curve in this market maker sell model formed prior to 8:30. So 8:30 starts right at the smart money reversal, and you get a continuation with a stop sweep happening with the 9:30 injection of volatility. And then we continue down into time. Here we have 9:30 starting, creates a false run. You get kind of a choppy range, drops down at 10 o'clock. You can either trade the market maker buy model here as it reacts into a discount level or a sell liquidity pool, trades up into the next target, or the market maker sell model in this case. And these timers are very specific. These elements in price that you can read and are very, very repetitive. There's only 7 or 8 profiles in this, and about every single day you can spot one of those 7. Here we have a large 8:30 news driver, 9:30 create the smart money reversal. You have a market maker buy model in this case. Same thing over here. Sell side of the curve was formed on before 8:30, or I guess outside of the chart in this case, and then you have the market maker buy model trading up back into the range. Here you have a market maker buy model pretty clearly. Same thing over here. And here you have an expansion. This is normally when you have a higher time frame level that's further off, 9:30 Judah swing, and then it trades pretty heavily off into whatever your drawn liquidity is. And notice it's always going to go from ERL to IRL. So if we're trading right at 9:30 and tagging something like a London high, the first thing your mind should be drawing to is where is our 15-minute or hourly discount imbalance. So an imbalance will always be IRL. So if we're trading up and taking out London high or Asian high and you have SMT there, we're going to be targeting both the time elements. So we want the trend to end around 10:30 or 11 o'clock and to trade into that discount imbalance at that same time. And obviously these are the 3 power of 3 profiles you'll see: open, high, low, close, kind of a delayed reaction off of that low, open, low, high, close, very quick reaction, or kind of a delayed protraction where you have a false, almost 2 Judah swings in this case, a false move up, Judah swing down, and then continuation. Now these, I guess the third profile here happens normally on low probability days, either before 8:30 news or on days where there's not a news driver. So something like a Monday or anything like before NFP. So Thursday of NFP week. Now for entries. So once we've identified the market maker model and the higher time frame levels, all those important factors, we can then look at entry points. So smart money reversal has happened, and we're looking at a low risk entry in this case. This is going to be your preferred entry type. We'll give you the most range and opportunities to take partials, things like that. So we're going to focus most of our attention around this low risk entry. Now there's 2 types of entries I like to use when we're finding the best high quality setups. And one will be a unicorn setup long. So when we're utilizing a breaker, the other one will be when price is reaching into premium or discount of the short-term dealing range. So in this case, we're looking at this kind of yellow box blown up here. we have a breaker in price with a low, high, lower low. That last up closing order block that's formed will be your breaker. And then normally you're going to have a fair value gap that lines up with the breaker in this case. So when we have something like this, you don't need to see price return into a short-term discount. This is where you can find a very quick entry. If there's multiple fair value gaps, you can either allow for a stop below that, or you just find a tight entry with that first fair value gap that lines up with the breaker, or even just as a breaker entry, stop being placed below the breaker. These are probably the easiest ones to get into and the quickest reactions, especially when you have a news driver at 10 a.m. or even a news driver at 8:30 and you have an increased amount of volatility throughout the day. The second entry type will be just a standard. Maybe you don't have a breaker, or you do have a breaker and there's multiple fair value gaps. What you're going to be looking for is that first fair value gap in premium or discount, depending obviously if you're looking to go short or long. So if we have multiple fair value gaps within that price leg, the displacement leg from the smart money reversal up into that market structure shift point that was taught in the 2022 model, you need to split that in half and look for the fair value gap within discount. So if there is no breaker, these fair value gaps up here will not be used as entry types, or entry points rather. So you're going to either have to miss an entry if it just bounces off that and flies up, or you're going to have to wait for it to trade through and look for that fair value gap. Now, if there's an order block as well in discount that lines up with that fair value gap, anticipate price to trade down into that order block and wick it maybe, and then climb up. So if you're trading off the discount fair value gap, make sure your stop is below whatever order block is supporting that fair value gap, because most times you'll see price reach into there and then leave. Obviously, if we're looking to go short, same exact thing. We may have a displacement leg down, multiple fair value gaps within that displacement leg. You're going to be looking for a premium fair value gap in that case, disregarding the ones that are in discount of that current dealing range. Other times you'll just have a very shallow discount fair value gap, but then you also have a breaker in price that was used as well to narrow down our fair value gap entry. So those are the two entry types, breaker or a fair value gap in discount or premium. And that will save you a lot of time from FOMOing in or entering on a poor fair value gap or order block that you shouldn't have. As long as you stick to those two, 90% of the time you'll get good entries, especially when they line up with the 950 macro and you have SMT and all the things before that that lead you into a high conviction trade as it reaches into its IRL or ERL target. I will go ahead and look at some examples here. Where we have 8:30 news, it comes down and reaches into a sell side liquidity pool in the form of an ERL. So we're going to be looking for a premium imbalance. We have one here on the 5-minute chart. And if you drop down to the 1 minute, 9:30 starts basically at the first stage of accumulation in the market maker buy model. So we're going to be looking for either an internal range stop run, and then an entry type, since there's no breaker, will be in discount. So we're using our second entry type. In this case, we have an expansion up, trades back down. We have a fair value gap here that lines up right at discount of that dealing range, and as well as one all the way down into here. So you have this entry with the order block, or this entry further in. Stop would have to be placed below that candle's low right here. And then at 10:02, eventually we trade up into the IR one last time and take out that short-term buy side. So in this picture, we're starting further in to the market maker buy model. It's not going to be perfect every single time. So it's not going to be a textbook setup, but as long as you can understand where we are within that range, it's much easier. In this case, we have SMT. We're trading up into a form of IRL, the London high, and we have SMT at the highs on the 15-minute chart. So we're going to target a discount imbalance. So we have a discount imbalance here on the 15-minute chart. That's where we want to see price go to. This case, 9:30 starts right at the smart money reversal. This is the easiest profile you want to look to trade for. And as we drop down, we have a breaker in this case. So price doesn't need to reach up into premium, but we have a premium reclaim fair value gap, trades up into, drops again. And then you have a inversion fair value gap. It taps into multiple times, and then it trades into the sell side right at the macro close. So a lot of times your entry types will happen, or your entry patterns will happen within that macro time. So as long as you can identify the first 20 minutes, what area of the market maker model we're in, where are we coming from, and where's the target, you can find multiple opportunities to get in before that 10:30 window. Now, this is the day of FOMC. That's why price action is kind of sloppy here. But if we go back and look at basically any of these days, you're going to see the same exact kind of stuff. In this case, we have SMT at the highs in the form of a ERL. So we're going to look for preferably a discount imbalance. We have a tiny discount imbalance there, but if you go down into the 1 minute chart, which is more important, here 930 is starting right at that smart money reversal. We have SMT to confirm the SMR, drops down. We have an entry given within premium of that short-term dealing range. Same thing down here. We have a breaker on the 15-minute, second entry type, trades down again, short-term dealing range, and then a fair value gap in short-term premium there. All within the macro time. You can short that, obviously looking for your 20-point partials, and then whatever the target is. In this case, we have London low as the target as it reached further than that IRL and discount at 1054. So just taking screenshots and journals of every day's price action will help you a lot in identifying the structures and patterns of things. Here you have another market maker buy model reacting off of IRL, 830 news in this case. You have 930 starting right at the second stage of distribution in the market maker sell model here. And then it starts a new market maker buy model. So you have SMT at the bottom, that smart money reversal happening around 945, and then another entry point given. Very similar to the other one, where you have a short-term dealing range between low and high for value gap and discount, multiple entry times with the order block being respected, and then it trades up into the original consolidation there, completing the market maker buy model. And you can go to any of these screenshots every day, and there's going to be a market maker model entry in every single one. I think we already looked at this one, but you can go back to any day, market maker sell model. So every single morning, you have your open, high, low, close, and then a market maker model on whatever time frame we're using. So in this case, 930 starts, I guess, that first leg, 10 o'clock news driver, SMT there, and then an entry given within the breaker as we drop down into a discount for your value gap. I'll show a live example of exactly what this looks like. So in this case, we have the New York sessions highlighted in green. We'll focus on Thursday's price action from this week. We have a dealing range between the FOMC high and the PM session low. So this is our current dealing range. And if we're starting right at 830 in this case, in premium, we're going to be targeting a sell side liquidity pool. We have previous day low down here as well as the PM session low. But you can see that the market maker model in the 1 minute will form off of a higher time frame level. So we have a fair value gap here. In this case, that price is trading into. And you can't really see the market maker sell model super clearly in this case. I guess you can kind of see some entries, but it's difficult to spot. And you drop down to your 1 minute time frame and you scroll back to Thursday. Right in here, you can see just basically half of that market maker sell model. If you were just looking at this normally, it just looks like a downtrending day. But when we zoom out, you have the full market maker sell model, and 830 is when we start that smart money reversal point. And now 930 is starting, I guess, at that low risk sell entry or even the first stage of distribution. And you have multiple opportunities here to find short-term premiums that you can trade and go short. And obviously, if you want to line it up with time, you have your fair value up here, an entry point given within 957, and that's in short-term premium. And then we trade off down into that sell side. And there's tons of partial opportunities, 44 points, 100 points down to PM session low, and then 127 points from that entry. So there's tons of different examples. You can go in and back test all of this stuff, and you'll find this works on almost any time frame. Obviously, if we're going from an hourly chart, you're going to be looking for a 5-minute market maker model. If you're going from a 4-hour chart, then it's going to be a 15-minute market maker model. But every time frame, that's what time frame alignment is and time frame pairing. You're going to find a higher time frame IRL, so for value gap or liquidity pool, and a lower time frame, you're always going to get that market maker model framework as long as it's not in line with the bias. So if you're just trying to look for market maker models on a lower time frame, it's going to be difficult sometimes if you don't understand exactly what you're looking for. If you go back to here, like swept out PM session low and previous day low, that's a form of sell side. You're going to be looking for a premium imbalance on the 15-minute chart. So here you can see the market maker buy model, but where do we stop at? Go back to the 15-minute chart. Here you have a premium imbalance right in here that price reaches into after it trades from that sell side liquidity. So 15-minute chart, maybe your draw, hourly chart, maybe your draw, but based on whatever chart you use, you can find frameworks for market maker models as we trade from sell side to premium, premium to sell side, or discount to buy side and buy side to discount. So here you have it stopping, and obviously time and price need to be lined up. So using the knowledge and method of reading price as described in this video, how do we get in and find entry types? Well, the model that I've developed is the ATM model. Obviously, I'm biased, and I think this is probably the best way you can read price and get in using just the New York session. But this is a full framework. Most times it happens on high probability days, and you can find 2 to 3 high quality entries per week, and you only really need 50 points a week. But you're going to be looking from 9:30 to 11 o'clock. So that's your New York session. You're going to wait for your 15-minute candle to print. And you can look for SMT. So that first 15 minutes should be reacting towards your ERL or IRL, whatever it may be. And you want to see SMT most times between NASDAQ and ES. Occasionally you'll use YM as well. Now that 9:45 or the 9:50 candle, that 5-minute candle needs to close towards the bias. So if we have a 9:30 open right here, it sweeps our high. In this case, we have SMT. We need to see our 9:45 or 9:50 candle on the 5-minute print bearishly. Now, we're using the 5-minute because sometimes on the 1-minute, market structure shifts and CISDs, change in state of delivery, will be skewed sometimes if you don't know exactly what you're looking for. To remove all of the fluctuations in price, the tiny little minute details on the 1-minute, we just look at the 5-minute candle. So as soon as that 5-minute candle prints and it's towards our bias, we can assume that on a lower time frame like the 1-minute, we've already been given our market structure shift, we've already been given our breaker, or we can just basically hunt a fair value gap using the 2 types of entries to get in using a market maker model, and obviously targeting our draw on liquidity from the higher time frame. So we got a 15-minute candle, probably reacting towards an IRL or ERL. We may have an ERL in this case, and NASDAQ fails to reach up into there while ES looks something like this. Wait for that 5-minute candle, maybe it's 9:45, maybe it's 9:50 to print bearishly. Then as soon as you get that, you look for your 1-minute entry. In this case, we don't have a breaker, so it'll be a short-term premium. And then normally it's during the macro time, get in short. Obviously, you have multiple different opportunities to take partials. And then in this case, if we're looking for ERL to IRL, you're going to use that as your full draw on liquidity, your full pull, the terminus. And your trend most times will end between 10:30 and 11. So we can either use time to exit, or we can just use our standard liquidity-based exit. So as soon as it hits our target, we get out of there instead of waiting for a specific time. Now, if we kind of a gem here, but if we put in a low at the wrong time, assuming everything is in motion, we put in a low here, maybe at 10:16. Well, you can see sometimes it trades back up into short-term premium, and then we'll reach further down and then put in a new low between 10:30 and 11. So you can use a full understanding of time within the New York session to hold trades longer and find preferred exits. I'll have an entire PDF just dedicated to New York session time elements. I'll put that in the Discord as well. So make sure you join that. And if you want even further insights, the private group will always be open. I have a whole playlist on YouTube that covers the ATM model. So there's tons of extra videos if you want to find examples, live examples, or even just backtesting data about this model and how to utilize it in live price action. Even if you go to the live stream recordings tab, the past 3 weeks, I think, have been focusing just on this model. And then there's also just public videos, short form kind of content, not short form, but 10 to 15 minutes of going from top down. Here's the bias. Here is the first 15 minutes. Here's the 5-minute candle. Here's the entry type, and how to manage the position in a demo, obviously, as soon as we reach that draw on liquidity. Now, depending on the news driver that we have present, sometimes you can see the kill zone times change. So sometimes you'll see 9:30 open here, maybe before the SMR, maybe after the SMR, or after the first stage of distribution, whatever it may be. If we have something like a red folder 8:30 news, what you'll see is occasionally 8:30 will be when you're going to start hunting setups, or when you're going to see it kind of start that market maker model. So 9:30 may be a little bit further on, and you have to get in continuation with whatever market maker model was formed at 8:30, or you'll be trading towards that 8:30 higher low if it was put in and we're now reversing at 9:30. So it's good to kind of shift your focus sometimes. When we have 8:30 news, you can still look between 9:30 and 11, but just understand that you may get the first stage or the first sell side or buy side of the curve. The first half of the market maker model may form at 8:30, and then you get a continuation from 9:30 or even a reversal at 9:30. Now that'll happen every single day, but most of your focus and the volatility will happen when we have an 8:30 news driver. So it's good to look for those high probability days, and days before 8:30 news, you either want to avoid it or just be more careful. 10 a.m. news is the same exact thing. It'll just speed up price. So whatever the draw on liquidity is, it'll continue to do its job and either act as a volatility driver towards the draw on liquidity, or it may reverse price. And on Friday, we had a great example where it reversed, and then we found an entry still within the macro time, but slightly right after that 10 a.m. reversal, got in and targeted the 8:30 news low. Now, any high impact news, I'm talking FOMC, NFP, or CPI, will greatly increase the volatility for the day. FOMC, it's best to just avoid that day entirely, at least for me. I'm going to avoid that New York session. Even if we have good setups, part of discipline and part of managing money and risk managing with trading is knowing when there's going to be low probability days and when to just stay out completely. So if you can identify days beforehand, just by looking at the economic calendar of when your trade setups are going to form and when you want to be using low position size or out of the market entirely, that's going to be towards your best interest. Something like CPI and NFP, it's best to just wait till after 8:30, preferably after 9:30, and you can either find reversal trades or just continuations. Time changes, it's not really much. When there's no news driver, most of the volatility is going to happen right at 9:30, and you're going to look to find trade setups towards 11 o'clock. When we have 8:30 news, you're going to find most of your entries happen between 8:30 and 10 o'clock. Normally around silver bullet time, you can get some consolidation or just reaccumulation for an extended move or reversal into lunch. So no news, look between 9:30 and 11. When you have news, look between 8:30 and 10. Normally between 9:30 and 10 o'clock, you'll find another entry as well. So going further into the low probability days and conditions, you first have to understand the two profiles. The most general understanding of price action in the New York session will either be a reversal or a continuation from London. So if it's difficult to frame one side of the market, either a bullish bias or bearish bias, and you don't know if it's going to reverse or consolidate or expand, really if it's going to reverse or expand, anticipate consolidation during the New York session. That doesn't mean it's untradeable. It just means it's going to be extremely difficult to find large ranges of moves. Taking partials and scalping is going to be your best interest, just getting in, getting out quickly, or just avoiding it completely. Days where you have a large London session expansion, sometimes you're going to get consolidation in New York. Any day before an 8:30 news driver, you're going to be careful, and Mondays especially. So those are the three that I would say you're going to kind of be hesitant towards or just very cautious as you enter into the New York session. Now, whether you're using the ATM model or just a macro or silver bullet, whatever your model may be, it's good to manage your expectations for the week. So for me, good target is around 50 points. That's on the low end. It's an easily achievable goal. You can get it within one trading day, and it's not terribly difficult to look for or even obtain. Really, if you want to double it, it's still a good target. Even a 50 to 100 points a week is manageable and within reach. Now, these setups do form every day. We're going to be looking from 1 to 2 high quality setups, normally on 8:30 news days, or on non-news days where there's no news the next day. If there's no news on a Wednesday and Tuesday, there's no news as well, you can look to trade Tuesday. If there's no news on Thursday, you can look to trade Wednesday. But if Thursday has news, Wednesday you don't look to trade, Tuesday you can. So Tuesday and Thursday is what you look to trade to find an ATM model. Just like reading price is important, psychology is also important. So I have some resources over here on the right side that I think are great. The Mental Game of Trading. It's a book by Jared Tindler, I think. That is a great resource. You can probably find it for 20, 30 bucks. ICT's Twitter Spaces are all posted on Spotify, are also posted on Twitter. You can find those easily by just a quick Google search. Those are great for psychology, especially when it comes to his own concepts and managing expectations and dealing with the psychological game. Mark Douglas also has some great resources on YouTube and books. So I highly suggest all three of these. I've used them all before. But just some general understanding of psychology and framework, you need to have some sort of injecting logic. This is something that CJ Trades talks about, that you have during the day. So when you feel those emotions rise, there needs to be something that you either tell yourself or you can read from your own handwriting that reassures you that nothing is wrong, and that as long as you follow your rules and manage risk and manage your expectations right, there's nothing more you can do besides following your rules and staying disciplined. And staying disciplined will always be and always has been the most important part of trading. It's just holding yourself accountable and saying exactly what you said you were going to do and sticking to that. So if you have a set of written down rules or typed up rules, and you can only take 1 or 2 trades per day, you have to stick to that. And you have to hold yourself accountable to staying to that, because no one is going to be over your shoulder assisting you and telling you what is right from wrong. The only person who's going to do that, and the only person who's going to save yourself, is yourself. So make sure you're journaling, make sure you're keeping your expectations lower than they maybe are right now, so you can just slowly just grind and reach the goals one by one. So your confidence and your ability to trade should be based solely just on your execution and not on the fluctuations in your wins and losses or your P&L. So as long as you show up with a chart, you follow your rules, you get in when you need to, and you stay out when you should, that will hold you better than a P&L trading over the long term. And obviously accountability is extremely important. So if you take a loss, if you break your rules, all of that should be documented and reviewed every day, every week, so you can gradually get better over time. So hopefully you found this video insightful. I'll try and link all of the videos and PDFs in the description below. Obviously, if you want to join the Discord, feel free to. The private group is also open. I'm covering the same exact model and framework every day in a live stream over live price action. Hopefully you can help build your tape reading skills and trust in the discipline aspect and a model more than anything else. If you have any questions, leave them in the comments below. I'll try my best to answer quickly and hopefully clear up any confusion that was produced whilst watching this video. If you enjoyed it and found it helpful, please leave a like and subscribe. I would greatly appreciate it. And until I see you next time, good luck and good trading.